Well, globalization is dead. I mean, it should have died a long time ago. But this period of globalization we lived through between I make it 1989 to 2010 or thereabouts. It was the second age of globalization. The first age of globalization was 1870 to 1914. And there was free trade, and bankers in London were selling bonds to investors in New York on Argentine credit, and letters of credit were moving. There was trade moving all over the world, and that it kind of resembled the late 20th century. And then it hit a brick wall at 70 miles an hour called World War One. And the New York Stock Exchange was closed for 5 months between August and December 1914. And as were most major stock exchanges around the world, and the gold standard ended immediately. People went through the pretense of having gold. What they did is they hoarded the physical gold and just printed money. So that ended, and then the rest. Hyperinflation in the early 20s, depression in the 1930s, World War II, Cold War. And it wasn't until the fall of communism in stages between 1989 and 1991 that we got back to globalization. But it was the second time. The first time was real. The second time was a fraud. You had people like Jeffrey Sachs at Columbia and Richard Haas at the Council on Foreign Relations and a lot of others promoting this. But what it really was an enormous theft from the United States of financial capital, intellectual property, et cetera, for the benefit of China. And I'd like to say that the only thing worse than a poor communist is a rich communist. So what we did is we created a lot of rich communists, and here we are. But no, the globalization is dead. It's been completely discredited. Tom Friedman and Richard Haas and Sachs and the rest can go off and write their papers, but the real world has moved on. And by the way, what she was describing goes back to antiquity, and there was explicit biblical references, but even earlier in Babylonian kingdoms, it's called a jubilee. And the idea at least in the Bible, in the book of Leviticus, every 50 years, all the debts would be forgiven, because they knew that people overborrowed. They knew that people lended recklessly. They knew that the system was overburdened by debt. This was all very clear. And they said, well, every 50 years we're wiping out the debt. And so you say, well, wait a second, isn't that a little unfair to the creditors, the lenders? But the point is, the lenders weren't dopes. So after the Jubilee, in the first year of a new expansion, I would be very comfortable making a 5-year loan, secured by land. But when you get to year 40 in a 50-year cycle, knowing what's coming, you're not going to make a 10-year loan in year 40. You'll probably make a 1-year loan, and by year 45, you're not making any loans. But here's the point, and this really gets into the physics of it. The system, with foresight, knowing the rules, voluntarily deleveraged itself in stages so that the Jubilee was not a train wreck. It was like there wasn't that much debt around because people saw it coming. And so what you were really doing was setting the thermostat in such a way that it would be self-regulating. And
right.
I'm sure some don't.
Whereas what we've done is the opposite. We've taken the brakes off the train.
That's because we got rid of the Jubilee concept. Now we have something better than a Jubilee that Pippa did not mention, and it is look, everyone else can default on their debt, including their dollar-denominated debt if they're an emerging market, et cetera. And you have Argentinian train wrecks all over the place, and she's right about that. But it all comes back to the United States. How does the United States default? There is no reason for us to default because we can print the money. The way the U.S. defaults is inflation. And in other words,
I agree.
Even modest inflation, 3% inflation for 18 years cuts the value of the dollar in half, which means the real value of the debt goes down by half. And by the way, we did this. In 1945, the U.S. debt to GDP ratio was 120%, the highest in history. And I like to say, yeah, but at least we won the war, along with our allies. So we got something for it. We were we had 50% of the world economy. But between 1945 and 1980, the debt to GDP ratio declined from 120% to 30%. When Ronald Reagan was sworn in, the debt to GDP ratio was 30%. And he was the first of the big spenders, and it's been going up ever since. Today, we're back to the World War II levels. But how did we do that? We did it with a couple of things. What's called financial fiscal dominance, financial dominance, which has been explained by Rick Michigan, where basically the Fed is the handmaiden of the Treasury, and they keep rates low. And all you need is negative real rates. Basically, if inflation is just slightly higher than the nominal rate, so we had nominal rates of 2-3% through most of the 50s and early 60s, but inflation was just a little higher than that, which meant that it was like an ice cube melting in your hand. It wasn't abrupt. It wasn't like blatant theft like FDR did when he confiscated the gold in 1933, although he gave you $20 in paper monies to not violate the Fifth Amendment. But the point is, that's how you do it. Now, here's the dilemma. The Fed has been trying to engineer this for 12 years, and they failed. I like to say it's a sad day when a central bank wants inflation and can't get it. And everything we talked about, including all the employees at my hypothetical restaurant does not hire back, and all the I forget which presidential candidate said, well, who cares if manufacturers get laid off? We can teach them to code. Um, Good luck. There's no evidence that people in midlife, mid-career with one skill set, which could be valuable, can somehow retool themselves and become coders. And that's probably a good thing, but they can't do it. There's no evidence for that. So how do you get out of this embedded high unemployment, embedded deflationary psychology, classic liquidity trap? Name your put out your descriptor. They all apply. How do you get out of that? The answer is inflation. But how do you get inflation when the inflationary psychology is so bad? It has been done twice, and I could do it in 15 minutes, and I explain this in a couple of my books. You call an emergency meeting at the Federal Reserve Board. You go in the room, you close the door, you take a vote, you come out, you walk up to the microphone, you say, ladies and gentlemen, as of today, the price of gold is $5,000 per ounce. If you think that's cheap, come and get it. We got a lot in Fort Knox. If you think that's expensive, serve it up. We'll pay you for it. And we got the printing press. And if you use the gold in Fort Knox and West Point, that's where most of the gold is. If you use the gold, the physical gold in storage and the printing press to conduct basically an open market operation in gold, this is how we peg interest rates. We buy securities with printed money and we sell them back and make the money disappear. But if you use the printing press and the physical gold to maintain say $5,000 per ounce price of gold, it's not to enrich gold investors. It's to get the price of everything else up. And FDR did this when he took, in the greatest period of sustained deflation in U.S. history from 1927 to 1933, the price of gold went up 75%, from roughly $20 an ounce to $35 an ounce. Why was that? Well, FDR did it. The government made it happen on a kind of gold standard at the time. But what he was really doing, this is what people don't understand. When the price of gold goes up 75%, nothing really happened to gold. It's atomic number 79. It's a metal. What happened was the dollar was devalued by 80%, and the price of everything else went up. FDR wanted the price of oil, corn, wheat, copper, everything to go up. And it did. 1933 was one of the greatest years in the history of the stock market because he bent the curve on deflation. Richard Nixon did the same thing by accident. Richard Nixon wasn't trying to do it the way FDR did, but he did it anyway by suspending the redemption of dollars into gold in 1971. Well, what happened by 1980? I mean, I took out my first mortgage loan in 1980. It was 13%. My poor mother cried. Her first mortgage was like 2%. But I said, Mom, inflation's 15%. So my pre-tax rate is -2. That's cheap money. That's better than free money. And we had 50% taxes in New York at the time. So my after-tax real rate was -7. So they were paying me a lot to be a borrower.